So in this chapter, we're going to start talking about shareholders equity or stockholders equity. It's actually one of my favorite topics, not from a bookkeeping perspective. The bookkeeping behind it's kind of boring, a little arbitrary and mechanical, but more so the theory behind equity and how it relates to the market value of the company. And we'll talk a little bit about that as well. But in terms of a super condensed overview, um, equity involves a lot of legality concepts, preferred versus common, the rights of shareholders, etc. And I'm not going to go over that too much. I'll assume that you had that in some of your other courses and business law, the obligations of dividends, etc. So I don't want to go too far into that. It seems repetitious in that way. I do want to define equity briefly because I think that that's one of the bigger issues that students face with shareholders equity is just what is it exactly? We have a great idea of what assets are, their future economic benefits. We have a good handle on what liabilities are. They are obligations to sacrifice those economic benefits. Well, in terms of equity, things become a little more slippery. So really one of the easiest ways to define it is by the net assets of the corporation. So when you think of equity as, well, what is left over after the claimants, the creditors, have taken everything that they will have in the case of liquidation, then equity is really the share of assets that are left for the residual owners of the corporation. So sometimes we call equity the residual interest in the corporation of the owners, the residual being what's left over after all of the liability stakeholders have been satisfied with their claims on the resources of the company. It consists of two pieces, really. We have a capital stock portion, and that's a direct investment. This is where we go out and issue shares of ownership, whether they be common or preferred stock securities, in order to get direct investments by shareholders. And of course, then we also have the earnings not paid out by the corporation, which are retained earnings. We can also have, as we've seen, accumulated other comprehensive income and treasury stock play a role in our equity, stockholders equity section. Treasury stock is actually a contra equity account. And we'll talk a little bit more about treasury stock in this module. But treasury stock represents the shares that the corporation has bought back. And because we've bought them back, the way we account for them is actually as a contra equity account. So that means that we increase them with debits and decrease them with credits. The accumulated other comprehensive income account, we've already seen, is a confluence of different gains and losses over time, losses due to available for sale securities, pension, cash flow hedges, and foreign translation. We've seen that it is a normal equity account, but much like retained earnings, it can have either a debit or a credit balance depending on whether there is an overall loss position in the AOCI or an overall gain position. Just as retained earnings could have a debit balance if the string of net income over a period of time has been losses. So these are usually going to be separated out. Capital stock versus retained earnings. Treasury stock will receive its own line item. AOCI will receive its own line item. There's one more that I don't mention here that we'll talk a little bit more about in class, especially if you're moving on to advanced financial, which I very much recommend when you're sitting for the CPA exam. They are non-controlling interests. And non-controlling interests refer to the idea when we consolidate our books. Consolidation occurs when we have greater than 50% ownership of another company, right? Well, if we own greater than 50 but less than 100, we are still going to consolidate the value of the assets of that company that we acquired between 50 and 100%, even though we don't own the full amount of those assets, right? And so non-controlling interests are the net assets of other corporations that we don't fully own. And like I said, we'll revisit this a little bit in class today and talk about that. But that is a big thing in advanced accounting, and that's basically what you're going to spend the entirety of advanced accounting looking at. But back to the more simple, basic elements of the equity section. Paid-in capital could be a lot of different types. This is the capital stock accounts. That could be common preferred. It could be convertible securities. And remember that when we have these capital accounts, we always record the primary at par value. And then anything in excess of that is recorded at additional paid-in capital. So, for example, if I have a share of stock that is bought for $5, it has a $1 par value, then I would have cash for $5 as a debit because I issued that stock, received $5 of cash for it. If it has a $1 par value, it's common stock, then we would record the common stock account at $1 and the APIC common stock at $4. So the APIC just represents everything in excess of the par value that is received for that share. When we're talking about par value, it has really no meaning anymore. Way back when, prices were not published and available for public consumption. It was a promise that we will not issue our stock below this par value. And it still is true that a company cannot issue shares below its par value. However, because that promise is not really necessary anymore, because everyone can see, all the investors have ready access to what stocks are being issued at these days, that promise is no longer a necessary item for companies to disclose. So what we see now actually is a lot of companies offering a zero par value stock, if it's allowed. It depends on which state the company is incorporating in. Some will allow the zero par value. If the zero par value is not allowed, then what companies will do is just set it at an extremely arbitrarily low value. For example, 0.000001 cent. I've seen in some cases where essentially it is zero par value. But anyway, it has nothing to do with the market value of the stock. It has nothing to do with any true value. All it does is give us, it forces us into a sort of classification schema whenever we are accounting for the book value of the stock, which sort of highlights the irrationality of how we account for book value of equity and what the true value of equity is. Right. Anyway, APIC represents the amount above par value for which the shares are sold, as we've seen, the $4 excess. And so when we're considering the issue price, it's always useful to remember that the issue price is equal to the par value plus APIC. In terms of how we will work through problems, we'll want to keep different APIC classifications. So for example, we're going to have a lot of different APICs. APIC from preferred, APIC from common, APIC from treasury, APIC from retirement of stock, APIC from stock options, APIC from tax effects from stock options. A lot of different APICs. This isn't necessarily done in practice. We certainly won't see this broken out ad nauseum on the face of the shareholders equity statement. A lot of this is going to be grouped together. A lot of it might just be disclosed in footnotes. And so there's no hard and fast rules about how much disaggregation into the various APICs we have to provide when reporting financially. However, for our purposes of working problems and for getting a handle on this information, we really do want to disaggregate as much as possible. Another item, issue costs associated with contributed capital. Issue costs similar to when we have issue costs for selling bonds, which tended to give a lot of people headaches. But For equity, it's much more simple. When we have issue costs associated with APIC, well, we're just going to take them issue costs associated with issuing stock. We're going to take them directly from APIC. So it's just going to be a reduction to my APIC amount. And that's it. We don't have any sort of matching. We don't have any sort of spreading of the cost over time. We reduce it from the cash value. We reduce it from the APIC amount. When we have bonds, we have a time period over which we can spread the cost. And that's why we incorporate it into our present value, modify the interest rate, and then charge essentially more interest over the life of the bond to match it over the maturity of the bond. Since equity is an instrument in perpetuity and has no maturity, we just go ahead and do a direct expense. And it doesn't actually hit the income statement. That's a big difference, right? Because when we issue for bonds, bond issue costs go to net income, but equity issue does not. They go to APIC. So they do both affect equity because, of course, when we reduce net income, that's going to trickle into retained earnings through closing entries. However, APIC skirts the net income treatment, and we're going to see that a lot in equity. When we reduce and increase equity, we are not going to typically ever want to record income movements. We might go straight to retained earnings. We might go straight to a contributed capital account, but we're going to find that there is no real net income effect. It goes straight to equity accounts. And that's something I do want to highlight. And we'll see again and again. But let's look at this example. For example, suppose a firm issued 1 million shares of $2 par value common stock for $5 a share and incurred issue costs of $350,000, record the journal entry. You could really record 2 journal entries just to make it clear what's going on here. We have cash of $5 million, $5 per share at 1 million shares. And I won't write all the zeros. And the par value common stock would then be at 2 million, because remember, we want to cap that common stock account at the par value. And then I'll do it in 2 just so we see exactly, so you remember, you just don't look at this journal entry and think, well, what the hell is going on? Then this would be $3 million because that's the excess of par, right? You know, this is your plug account. Every chapter has a plug account. Remember, additional paid-in capital now is our plug account for this chapter. Next, we have to account for those issue costs. Well, then that would just be a debit to APIC common stock for $350,000 and then a credit to cash. You can combine those 2 entries if you'd like, and that would be fine by me. Also, of course, always want to focus on the statement of cash flow effects. Not too difficult here. This is a cash flow from financing activities. We issued stock. It would be a cash flow from financing activities for the addition of those 2. So our cash flow from financing activities has an inflow of $5 million. So now let's look at some non-cash equity issuance. So sometimes we may not issue for cash. We'll issue for goods. We'll issue for services, assets, land, whatever. We're essentially swapping 2 non-cash items. And if you recall from your long-term assets, non-monetary exchanges, what we want to do in this case is record it at the fair market value of whichever item is most clearly determinable. So the fair market value that is most evident. So not all fair market values are created equally. We discussed briefly in class level 1, level 2, level 3 fair market values. So we're looking for fair market values that are reliable, that are readily determinable. If we have an active market, for example, a publicly traded stock that's liquid, right, then we should probably use that stock as the basis of valuation because that is a readily determinable fair value. However, if no active market exists, maybe it's a privately held stock. Perhaps it's a share of restricted stock. Maybe it's a stock with options on it. Then it becomes a little more difficult for us to value. Perhaps what we're trading it for would be better. So let's look at two examples. I say that ABC exchanges 1,000 shares of $1 par value for a building. The market value of the stock is said to be $50 per share, and the building is supposedly worth $45,000. So if we have a market value, and I would try to be a little bit more explicit on the test without guiding you verbally, but let's say that this is a liquid, actively trading stock, because if it wasn't actively trading, that price point might not be all as precise as we want it to be. But in this case, it is. So then we would say, well, if we traded 1,000 shares and the market value was $50 per share, then what's the value of the building? Well, if we're taking it on a liquid, actively trading stock, then the building would just be worth the market value of the shares that we traded for it. So that would be $50,000. Now, how do we record the stock issue? It would be by the rules we've seen before. We do the $1 par value for the amount of shares we issued, the 1,000 shares, and then APIC CS would be the remainder. Notice, however, now we have a non-cash transaction. So there's no effect to the statement of cash flows here. That's why one of the requirements for the statement of cash flows is to disclose all non-cash transactions, because otherwise you might look at the increase in common stock from one balance sheet date to the other and suspect, oh, well, if this increased $50,000 overall, we must have gotten $50,000, until you see that note, and then you see, oh, well, there's no effect. There's no cash being traded. So it's not a cash transaction. What if the company is privately held and the stock and the stock is valued based on appraisal? Then you could probably make a case for valuation of the building instead of the stock. So maybe we have property tax appraisal on the building. Then we would say, well, the building is worth $45,000 because the stock is not a readily determinable value. It's privately held. It's not actively traded. In that case, since it still has a $1 par value, we would still want to record CS at par, and then APIC would be our plug. As I said, this is our plug account, this chapter. So when in doubt, something doesn't balance, probably an APIC account, right? All right, so let's look at a problem. And I try to be a little creative with these equity problems. I really want to get you thinking. I really want to get you working from balance sheet totals rather than a sort of rote plotting forward of facts. I know that's not real world. The classroom isn't the real world. I'm really helping you with those more soft skills of critical thinking, because if you've gone to any sort of talks, the employers say, look, we can teach you rules. What we can't teach you is how to think. And so that's where I try to take a little bit more ownership beyond the rules. It keeps me from going crazy, because otherwise I would just be a walking rule book, and that's not fun. So anyway, let's look at these two scenarios one at a time. Winchester has had only one equity issue in its history. No other transactions have affected its APIC account. Under scenario one, what is the original issue price for Winchester shares? So if it's only had one equity issue, no other transactions, and this is what we have for its shares, I'll give you a moment to think about that. Maybe try to solve it on your own. Pause the video here. How would you come up with the issue price? You recall, I said something about issue price. So what I would do is make a journal entry where I look at, well, if this was raised all under one issue, then I know that the common stock of 1 million and the APIC common stock of 9 million came from one issue where it was $10 million. Well, that's the original issue, but that's not necessarily the issue price, right? Well, then how do we know the issue price? per share. So we have a $10 million issue. What is the issue price? Again, think about how you could figure out that information per share. Well, what gives you per share information? If we take the 1 million, how many shares do we actually transact? Or how many shares do we actually issue here? Well, if it's a $1 par, we had 1 million shares. And so the $10 million divided by 1 million shares gives me an issue price of $10 per share. So now let's look at scenario number 2. Again, we only have one equity issue in the history of this company. No other transactions. Assuming the firm's common stock was originally issued for $3 per share, what is the stock's par value under scenario 2? So it was originally issued. Now I'm giving you what the issue was, $3 per share, and then asking you to figure out what the par value is. So let's think about, again, how could we do this? I would think about a journal entry here. Think of journal entries when you don't have 2 dates. Think of T accounts when you have 12/31/16, 12/31/17. So here I have common stock of $10 million, and I have APIC being created for $5 million. Well, that gives me cash of $15 million. So we have $15 million issue, and it said that it was originally issued for $3 per share. So that would imply to me that we have how many shares? 5 million. So that was the number of shares issued. So how can I figure out par value? Think about what account is actually recorded at par value. Oh, all right. Yeah, that's the common stock account. It's 10 million. And if this represents 5 million shares, then that means that the $10 million par value divided by the 5 million shares gives me a $2 par per share, right? So using the basic bookkeeping ideas, but giving it a little bit of a spin, giving it a little bit more of a thought process behind it. So I mentioned equity repurchases briefly. I mentioned that we call them treasury stock. And treasury stock is the accounting term for any time that a firm initiates a share buyback. So why do firms repurchase shares? It might be that they compensate their employees with stock options, and so they need more shares to distribute. So it could be to just satisfy a pending option requirement. They don't want to issue new shares. They don't want to dilute the existing ownership of their current stockholders. And so to avoid that, they will buy back shares from those willing to part with them and then just redistribute them to their employees when they exercise stock options. They might readjust their capital structure mix. They might want to be reducing their equity rather than buying back shares. Rather than reducing their leverage. Maybe they have too much equity. Really, a big reason is that they think the shares are undervalued. So they think they're undervalued. What does that mean? Why does a stock buyback make sense? Because remember, in order, of course, an equity purchase of treasury stock, a stock buyback has to happen at a price greater than the market price, right? That's the only way they're going to get people to sell it back to them, because if they just offer the market price, the stockholder could trade with someone on the market. Well, it's an instance of putting money where your mouth is, right? Putting money where your mouth is, which is an English American saying, don't just talk, be willing to put some money down on your words. And in this case, management might have some information that leads them to believe that their stock is undervalued. Well, they're not going to pay a price more than the intrinsic value. They're not going to pay $20 for something they know is only worth $15. That would be a waste of their money. And because management has an inside scoop, because there's an information asymmetry that's imbalanced toward management rather than outsiders, this is a signal of a way for management to show stockholders that they believe their stock is undervalued. So it's also a signaling theory, which is kind of coming from finance. And another reason is that it's become an increasingly prevalent way to alternate or substitute for dividend payments. Firms do not like dividends. They used to be dividend paying machines, especially firms that were older, had fewer investment opportunities to put funds toward. Now they tend to buy back shares instead. The reason being, it's more flexible. Dividends, once initiated, have to be maintained. Otherwise, shareholders lose their freaking minds, right? Stock prices tend to plummet. Maybe that's a little bit of an exaggeration, but they do fall when dividends are missed, when dividends are cut. Tends to be a signal that the firm is having issues if they can't maintain their dividends. So a more flexible way is to just put a number of shares out there, allow people to repurchase as they allow people to sell it back to the firm as they wish, and that is overall beneficial not only to putting money into the shareholders' hands, as does a dividend, but it also helps the firm because they're not fixed into an obligation that's ongoing over time. And they still do get a price bump. We find that on average, the investors will there will be a slight appreciation in the price of stocks around a share repurchase program, because it is seen as a positive signal by management. As I was saying, they're putting their money where their mouth is, and revealing, if you will, to investors that there is positive news coming in the future. However, there's a caveat, and this has been shown again in academic research. If the move is purely mechanical, so for example, if the firm has a large number of options outstanding that have not been exercised by its employees, and therefore it's more likely that the firm's simply repurchasing not to dilute ownership, then there's really no price response to this. It's a kind of an interesting footnote to that. All right. So how do we account for it? So like I said, treasury stock is the account that we use. As I mentioned before, it is a contra equity account that represents a reduction to my overall stockholders' equity. You'll see why it reduces in a moment, because when we buy back shares, we don't debit common stock. We debit treasury stock. There's two different methods. Par value method, in practice, it's rarely used. I don't want us to use this method in class. It could be tested on the CPA exam, so I give you the rundown on it, but it's not the one that I'm going to make you really learn and utilize, or how my problems are structured. The cost method is the one that is more typically used, the one that I want you to learn. In this case, in both cases truly, but in this case, treasury stock is carried on the balance sheet as a contra equity account at its repurchase price, and that's the difference. Par value carries it at par value, but whatever. If it's reissued, because we buy back shares, but we will reissue them eventually, then we would, as part of the reissue, have cash and then credit treasury stock. Now, the difference between that price is going to go to an APIC account, APIC from treasury stock, and or retained earnings, depending on which way it goes. As you can imagine, we're never going to credit retained earnings because of conservatism, but we will debit it if we have no more APIC treasury stock. If the stock is retired, this is when we actually debit common stock and APIC common stock and then credit the treasury stock. But the idea is that it has to be repurchased before retired, which makes sense, right? You can't retire a share that is publicly held. It can't just disappear from someone's hands, through force, right? So we have to buy them back, and then we can retire them. But unless we retire them, we're not actually going to debit common stock. So a rundown of that is in this table. I give you some verbiage here. I'll just go ahead and record how we do this from a debit credit standpoint. For the repurchase of common shares, we debit treasury stock, and we credit cash because we had to spend some cash to do it, right? If we reissue treasury stock and it's greater than cost, so I'll toss some numbers in here. Let's say that we spent $8 to retire it originally when we repurchased it, and then we reissued it for $15. Well, then we would get, if it's just one share, real simplistic, $15. And then we had treasury stock here. Well, we credit it at cost, kind of like inventory, right? We bought it at $8. We recorded at $8 when we repurchased it, so we credit it out at $8. And then any excess goes to APIC treasury stock. If it's the opposite case, so we did retire for $8 and we reissued it for $5, then we have the opposite situation occurring here. Where we need a debit in order to finish this off. So let's ignore the fact that I just recorded a $7 credit here. If I have enough APIC, I drain APIC TS first. That's my first stop. If there's not enough APIC TS, I drain retained earnings. So I will never credit retained earnings. That's what I was saying. I'll never credit retained earnings because any excess of the reissue price over the cost of the treasury stock will always increase APIC TS. But when we have the opposite situation, APIC TS has a finite amount. It can only get reduced to 0. So once it's been reduced to 0, we go to our retained earnings next. From a retirement, we debit common stock. We debit APIC common stock. These are both at the original issue price. Well, obviously this at par, and then the APIC from issue. So if it was $9 of excess per share at the issue, then that's what we debit there in accordance with retiring that stock. We credit treasury stock, and then whatever that was at cost. And yet again, it depends whether we have need of a debit or credit, but the same rules as these two are followed, so that if we need additional debits, those will be our debits. We debit APIC until it's gone, and then we move into retained earnings if necessary. Okay. Typically the case that we'll be buying back greater than the issue price, but if it wasn't that case, then we would credit APIC treasury stock for any difference. Okay. So just looking through some real simplistic journal entries here. 6,000 shares, $10 par value common stock issued for $12 per share. So the original entry in issue, $12 per share, that would be $72,000. We have common stock at a par value of 10, so that's 60. And then APIC would be the difference between them. 1,000 shares are repurchased at $13 per share. So in this case, then we would have our treasury stock account because we're repurchasing for 13, cash for 13. Now we reissue 600 shares for $15 per share. And then when we do that, that has a $9,000 cash price. Remember, because when we reissue, the firm is getting additional cash for it. And well, what did we buy those back at? We bought them back at $13 per share. And so we record the credit to treasury stock by taking 600 and multiplying it by $13 per share. And then the difference goes to APIC treasury stock. 300 shares are reissued at $8 per share. That gives me $2,400 of cash. And treasury stock is still at the $300, 300 shares at the $13 cost. And so that gives me $3,900. Well, now we need a debit, and notice that our debits cannot exceed $1,200 to APIC treasury stock because that is the finite amount that we have. I'm going to reduce that to 0. The rest will come from retained earnings. And then I say the remaining 100 shares are retired. Common stock, APIC, common stock. Well, what was the APIC associated with each common share, right? Well, $10 par value, $12 per share. That's $2 of APIC per share because that was the excess of the market price over the par value. And so APIC common stock debit, that's typically the harder part to figure out because you have to go back and figure that out. Then the $10 par value, then we have $1,000 of a debit to common stock, and treasury stock is going to be $1,300. That's the 100 times $13. And then again, looks like we need a debit of $100 in order to balance this. We have no more APIC, so it comes from retained earnings. Another thing I want to point out that isn't in this problem, but is to keep track of shares authorized, issued, and outstanding. Really, the two that are important here are issued and outstanding. Authorized simply is the initial grant. When a company incorporates, they incorporate for a certain amount of shares. So that's their authorized amount. They set it really high because they want to be able to issue those shares. If they have to exceed that, they have to file another class of shares, another incorporation. So they try to avoid that. Shares issued are shares that were at one point or at some time in the past or presently in public's hands. Outstanding are shares presently in public's hands. Right? So looking at it from that perspective, then we issued 6,000 shares of common stock. So that means that there are 6,000 issued and there are 6,000 outstanding. Oh, and then the reason why I said greater than or equal to is that it must always be the case. These are outstanding as a subset of issued. You can't have more in the public's hands that were, by the definition of issued, either currently or in the past in the public's hands, right? In this case, then, 1,000 shares are repurchased. Well, that doesn't change my issued because they were at one time in the public's hands, but they are no longer outstanding. And again, we now reissue 600 shares. That doesn't change issued, but it does change outstanding. Here we have doesn't change issued, does change outstanding. And then if we retire 100 of these shares, this is when we actually change issued. Notice a handy thing to keep in mind is that issued, if you can verify it, minus outstanding equals treasury shares. You know me, there's going to be a way that I'll make you figure that out in a problem somewhere. So issued shares minus outstanding shares gives you treasury shares at a point in time. And then when you retire them, that's what reduces our issued shares. Or if you issue more shares through an issuance, then you have more shares. But if you're just purchasing and repurchasing and reissuing, that's going to affect outstanding shares. I would like you guys to work through case 2 as well as case 3. I think that those two are simple enough. We'll save case 4. If you want a challenge, go ahead and start on it. A little more difficult, a few more things going on between these two balance sheet dates, but you can definitely sink your teeth into case 2 and case 3. Thank you very much.